Hi friends, today we are going to discuss Reserve Bank of India and its functions, monetary techniques used in money market and RBI and money market. So very simple video we would like to present here. Let us start with RBI and its functions. We know that Reserve Bank of India is an apex institution of banking sector in Indian financial system. It's the most important player in the Indian money market also. It is the nerve center of financial and monetary system in India. It's the backbone of our Indian financial system. The organized or structured money market coming under the direct regulation of the RBI, Reserve Bank of India. In such a way, Reserve Bank of India possesses a special status in our country. The main functions of RBI is to maintain monetary stability and to maintain stable payment system in our financial system. Another important function of RBI is to regulate overall volume of money and credit in the economy with a view to ensure a reasonable degree of price stability. Then many functions of RBI have another important function is to regulate and ensure the liquidity and interest rate through n number of operating instruments such as cash reserve requirements of banks, open market operations, changing banking rate, banking interest rate, and foreign exchange swaps operations, etc., etc. N number of measures are taken by the RBI to ensure the liquidity of the fund in our financial system. The role of RBI plays in Indian financial system as a regulator. It includes first one, that is note issuing authority. As per the section 22 of the Reserve Bank of India Act, the Reserve Bank has given the sole right to issue currency notes in our country other than 1 rupee note and coins. Currency notes of 1 rupee and other subsidiary coins are issued by the Ministry of Finance directly through Reserve Banks. Rest all notes issuing capacity has vested with this Reserve Bank of India. The next important function that government banker. RBI is act as a banker or an agent or an advisor to the government as per the obligation created under the section 2021 subsection A of the Reserve Bank of India. As a banker, there are three capacities. First one, as a banker, as a financial advisor, as a financial agent. We are discussing these three capacities. Let us take first one as a banker. As a banker, Reserve Bank of India have a statutory obligation of keeping money of the central bank and state or central government and provide other services free of charge. So he is acting as a banker to the government. Then the banker collect money on behalf of the government, make payment on behalf of the government. Its branches and the branches of the State Bank of India all over the country doing the same procedure on behalf of the state government or central government. It also acts as the banker to the state government and undertake the above mentioned businesses, etc. Then it make arrangement for foreign exchange to the government, it may be state government or central government. It provides a ways and means loan to the government for the period not exceeding 3 months. It's a short term. It's provide a short term arrangement for settling the needs of the finance in terms of loans or advances. The next capacity does it as a financial advisor. RBI act as a financial advisor to the central government and state government. It helps them generally to formulate financial and economic policies, and it helps for many hints and clues for formulating economic policies in such a way. RBI act as a financial advisor to the government, it may be state government or central government. It advises on certain aspects of formulation of 5-year plans, such as financing pattern, mobilization of savings, and institutional arrangement with regards to the banking and credit matters. And the last capacity as a banker, government banker, is as a financial agent. RBI is the representative of the government of India in the World Bank and IMF, or International Monetary Fund. It sells treasury bill on behalf of the central government. It acts as an agent of the central government and state government in the matter of flotation of loans and advances. So in such a way, it acts as a lender of last resort or financial agent. The next important function, that is banker's bank. We are discussed the government banker. Now we can see a banker's bank. RBI has the right to control and supervisory role the activities of all banks in the country by way of issuing licenses, giving permission to commence branches or to start new branches, etc. and etc. It controls the volume of other reserves like statutory liquidity ratio, cash reserve ratio, etc. And determine their deposit credit creation ability, etc. etc. In such a way, Reserve Bank of India act as the banker's bank. And another important function, that is supervising and regulating authority. As we have discussed, RBI has a capacity to supervise the entire matter taken places in our Indian financial system. It is the regulator and supervisor of our monetary system. It is acting as a watchdog of our Indian financial system. It provides a broad parameter within which banking and financial system of our country functions. It regulates the money market according to the provisions of RBI and the Banking Regulation Act 1949. Then two functions we have as supervising and regulatory authority. First one, exchange control authority, and the second one, promoter of the financial system. Now we can see as an exchange control authority, RBI develop and regulate the foreign exchange market. Its role is to facilitate external trade and payment and provide development and maintain a foreign exchange market within the framework of foreign exchange, FEMA. Then we know that FEMA and FERA. Then next, that is promoter of financial system. RBI has taken a number of steps to promote financial system or a good financial system in our country. It creates certain financial institutions like IDBI, IFCI, state financial corporations, Indian Industrial Bank of India, Exim Banks, Unit Trust of India, SIDBI, NABARD, etc. and etc. Okay. Now we can see monetary techniques formulated by the RBI. We are already discussed RBI formulate and conduct monetary policy. Monetary policy means the use of the techniques of monetary control measures to achieve the broad objective or maintaining the price stability in order to ensure adequate flow of credit to the productive sectors. Number of measures have taken by the RBI in order to control these, or in order to achieve the broad objectives of our Indian financial system. Some of the selected measures have discussed here. First one, that is open market operation. Open market operation of the RBI consists of purchase and sale of government securities in the open market. Purchasing of securities and selling of securities in the open market is a mechanism of open market operation. It is done with a view to regulate the supply of money. It's not widely used techniques of monetary control. As per the provision of the RBI Act, that this act empower the Reserve Bank of India to purchase and sell government securities and such securities of local authorities or state government, etc., etc., in an open market. And another important techniques, that is bank rate, is the standard rate at which RBI buys or rediscount the bills of exchange or other eligible commercial purpose. It is also the rate that the RBI charges on advance or loans on specific collateral to the bank. So it helps to regulate the availability of finance. Interest rate on different types of accommodations from RBI, including the refinance, are now linked to the bank rate. The next three important things, that is cash reserve ratio, statutory liquidity ratio, liquidity adjustment facility. Let us see first one, that is cash reserve ratio. We know cash reserve ratio means it's a fixed percentage of their time and demand deposit as cash reserve with RBI. Is the rate of as a cash reserve ratio. That means every scheduled bank should maintain a fixed percentage of their time and demand deposit as cash reserve with RBI. That is called cash reserve ratio. Then it is called statutory cash reserve ratio. This cash reserve ratio is also known as statutory cash reserve ratio, only because of all scheduled banks are maintain this reserve ratio as a statutory obligation. Then next one, that is statutory liquidity ratio. That means, as per the section 24 of the Banking Regulation Act 1949, every commercial banks is required to maintain not less than 20% of their total time demand liabilities in liquid asset in the form of cash, gold, or unencumbered government and other securities with RBI. This is known as statutory liquidity requirements or statutory liquidity ratio. The difference between this cash reserve ratio and statutory liquidity ratio is every scheduled or banks should maintain their fixed percentage of time and demand deposit as cash with RBI is called cash reserve ratio, whereas in the case of statutory liquidity ratio, certain percentage suppose that is maintain not less than 25% of their total time and demand liabilities. There is a minimum percentage as a statutory to not less than 25% of total demand and time liabilities in liquid asset. It may be cash or gold or any other government securities with RBI. So it is also known as statutory liquidity ratios or requirements. Then next one, we know that this reduction and increase in SLR or CRR will helps for the availability of funds in our Indian financial system. Okay, the next that is liquidity adjustment facility is another important techniques which is used by the RBI to control our Indian monetary system. We know liquidity adjustment facility is known as LAF. That means it's one of the most important instrument of monetary policy in the recent years. It is newly engineered product of RBI. It was introduced RBI during 2000 June to ensure smooth transition and keeping pace with the technological upgradation. The funds under LAF for liquidity adjustment facility are used by the banks for their day-to-day mismatches in liquidity. It's a tool used in monetary policy that allows banks to borrow money through repurchase arrangement or agreements. Arrangements allow banks to respond to liquidity pressure and is used by the government to assure basic stability in the financial markets. And the last one, that is a repos or a reverse repo. Repos or reverse repo, that means repurchase operations. It's an instrument of money market. Repurchase operation is a repurchase agreement. Repo is the sale of securities. Usually these securities are government securities or debt securities. This purchase agreement, this repo agreement is the sale of securities tied to an agreement to buy securities back later. It's an agreement to purchase or to buy these securities back later. A reverse repo is the purchase of securities tied to an agreement to sell back later. This is just opposite of a repos. It is also a mechanism or a technique which is used to control monetary system. This agreement can be viewed as a loan secured against the security. And one more thing that we are missed to explain, that is refinance. RBI uses these instruments to relieve liquidity shortages. Refinance is the mechanism to relieve or to give some freedom. Refinance rate is also now linked with bank rate. Bank rate we are discussed here. Then currently there are two types of refinance schemes, such as export credit refinance and general refinance. And these are all the important techniques or monetary techniques which are exercised by the RBI in order to control or monetary or Indian money market or monetary policy. Let us conclude here. Now we move to next one, that is RBI and money market, in our next video. Thank you all. Next we can see RBI and other financial institution in money market. We know RBI has modified its operational and intermediate objectives of monetary policy several times in response to the changes in the economic and financial environment. We know that Reserve Bank of India formally adopted monetary policy targeting with the feedback as nominal anchor or fight inflation. In order to meet the reserve requirements, bank borrowed primarily from interbank or called money markets. Hence, these transactions were reflective of the overall liquidity in the system. Accordingly, the Reserve Bank focused on the money market, in particular the call money market, by using various direct instruments of money control to monetary control to signal the policy stance consists with the overall objectives of achieving growth and price stability. Another important is that over and above, there are several credit instruments which involve similar maturity but diversely different risk factor. Such distortions are accessible only in rising and diverse economic like Indian economy and need extra care while handling the issue at the policy level. The next important player, that is government. Government is the most active player and largest borrower in the money market. Government raises fund to make the budget deficit while preparing their union budget. Fund may be raised through issue of treasury bill uh, or and other government securities. Government has several ways to control income and interest rate, which can be divided into uh, two groups basically. First one, that fiscal policy, and another one, that is monetary policy. Then another important player in the money market is banks or commercial banks. Banks plays an important role in the money market. They undertake lending and borrowing of short-term fund. We know money market is a financial or institutional arrangement for short-term finance. The collective operation of the bank on a day-to-day basis are very predominant and hence have a major impact and influence on the interest rate structure and liquidity position. Then another important player is financial institutions. Financial institution means those institutions which are dealing in finance. They undertake lending and borrowing of a short-term fund. They also lend money to banks by rediscounting bill of exchange. They transact in large volumes than banks. They have a significant impact on the monetary money market. Then another player in this money market is corporate firms. Corporate firms operate in the money market to raise their short-term fund to meet their working capital requirements. They issue commercial papers with a maturity of 7 days or up to 1 year. These papers are issued at a discount and redeemed at par on maturity. In such a way, corporate firms are play a vital role in our Indian money market. Then one more player we have, that is institutional players. It consists of mutual fund, foreign institutional investors or foreign institutional players, insurance firms, and other institutional agencies, etc. Their level of participation depends on the regulation. IRDA have its own regulation. SEBI has some regulation, etc. The level of participation of the foreign institutional investors in the Indian money market is restricted to invest in government securities. Now, a number of changes have been taken places in these areas. So let us conclude today's video here. Thank you to all.